This is Ethan, CFA Charterholder and investment professional, and today I'm going to show you how GPIX, JEPI, and SPYI stack up on 5 key metrics for covered call ETFs: income level, income consistency, long-term growth potential, downside protection, and tax efficiency. Let's dive in. At the most basic level, all of these are covered call ETFs based on broad US stock portfolios. If you already know what that is, you can skip ahead about 45 seconds to the next chapter. For those who need a refresher, we'll start with that. What is a covered call ETF? In a nutshell, it buys stocks, then writes or sells, which is the same thing, call options against them. A call option gives the buyer the right to buy a stock at a set price. Of course, they'll only want to do that if the stock goes higher than that price. So if you're selling those options, like these ETFs are, that means that someone else gets to benefit from the upside in the stocks if they go up a lot. So to recap, these ETFs buy stocks, then sell call options on them. That means you get a little of the upside potential, but then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A massive yield. And that is the main reason people buy ETFs like GPIX, JEPI, and SPYI. So let's start with how their differing approaches will impact their payouts. On the upper left, you can see that SPYI shows the highest yield, 12.1%. On the right, you can see JEPI pays out 8.2%, and on the bottom, GPIX pays 1%? Hold on, what's going on here? Well, if you look closely, SPYI is quoting the distribution rate, JEPI is quoting the dividend yield, which is actually the same thing, but then GPIX is only quoting the SEC yield, which does not count the income from option premiums. Well, that's where most of the income comes from, so if that makes sense. The dividend yield / distribution rate calculation is actually total BS. It only takes the most recent dividend payment, then multiplies it by 12, and divides it by the NAV for the most recent ex-dividend date. If we use that same calculation for GPIX, we get a yield of 8.71%. But I actually like that Goldman Sachs doesn't play that game. Another interesting thing to note is that if we look at the SEC yields for all of these, SPYI is only 0.7%, GPIX is only 1%, but JEPI is still at 7.8%. How is that possible? Well, that's a neat little trick they're using that has major tax implications. More on that in the tax efficiency section later. In my opinion, the only real legitimate dividend yield calculation you should pay attention to for stock funds is the 12-month distribution yield. It's not a perfect predictor of the future either, but anything that looks at 12 months of data is better than something that looks at 1 month of data and assumes it will always be exactly the same 12 times in a row. With these strategies in particular, it hasn't been that big of a deal, but with some others that really try to maximize their income, like the ones from Roundhill with weekly distributions, that yield figure can jump around like crazy week to week and really tells you absolutely nothing about what you can expect in the future. The 12-month yield on SPYI is 11.7%, it's 7.1% for JEPI, and GPIX doesn't have one yet since it's just hit its 1-year track record and it hasn't updated yet, but based on the distributions it's made so far, I'd estimate it will be roughly 8%. So that brings us to the main question. Is SPYI always likely to have the highest yield? Yes, probably, in my opinion. SPYI is based on the S&P 500 and writes options on 75 to 90% of the portfolio, 1 to 4% out of the money, to generate a consistent monthly income. That's why the 1-month figure of 12.1% and the 12-month figure of 11.7% were pretty much the same. The more of the portfolio you write options on, and the closer you write them to the money, which is the current price, the higher your income will be and also the lower your upside potential will be. We'll focus on upside potential later, but these compare to JEPI, which sells options roughly 2% out of the money, so a similar level, but only on up to 20% of the portfolio. Since JEPI creates a lower risk version of the S&P 500, its underlying holdings are likely to have a higher yield, but it will likely generate less option income and also less total income than SPYI. GPIX sells options at the money or close to it and on a very wide range of 25 to 75% of the portfolio, so it could fluctuate a lot if they wanted it to. However, GPIX, like SPYI, also tries to keep income consistent. Again, we'll dive more into consistency in a second, but that leads me to believe that if their yield is around 8% so far, based on the limited history, it's not likely to go up over 12% to exceed SPYI's. So, on income level, SPYI is the winner. It's been the highest of these three, and it's likely to stay that way in the future. Now, what about consistency? Both GPIX and SPYI are specifically managed to keep income consistent. JEPI is not. So let's take a look at how consistent they've been. Here are the monthly distributions of SPYI in blue, GPIX in orange, and JEPI in gray since the beginning of 2023, or in GPIX's case, just since its inception. Don't worry about the level. These are all on a per share basis, and these ETFs have different share prices. But what I want to show you here is the consistency. SPYI's and GPIX's income have both remained pretty consistent, whereas JEPI's has bounced around like crazy. We could nitpick and say GPIX's has been maybe a tiny bit slightly more consistent than SPYI's, but honestly, these are both so much more consistent than almost every other covered call ETF out there I've seen. I'm going to call it a tie. If you really want perfectly consistent income, you should probably just stop relying on dividends of any kind and implement a systematic withdrawal plan. Let's move on to our long-term growth potential section. If that's not why you're investing in these, it's still important because it determines the long-term sustainability of your income. So your income is 8%. Well, 8% of what? The NAV. And if the NAV is declining over time, your income will be too, even if it stays consistent at the same percentage. Sadly, we can't buy groceries with percentages. So we need a strategy that can grow over time to create a growing income stream that will keep pace with inflation. This is assuming you're taking out all of the income. Obviously, any of these can create a growing income stream if you're reinvesting the dividends, but I know most people don't want to do that. Let's start with JEPI since it's been around the longest. I'm actually going to use its mutual fund counterpart, JEPIX, since it's got a longer track record and they're basically identical. Since inception, its price has fallen 2%. Not growing, but at least not rapidly deteriorating either. And it's been through some decent volatility in that period. Its low volatility approach also helps, but more on that in the next section. But on the other hand, the S&P 500 has actually doubled over that time frame, again without the dividends. So you're not always going to get that good of returns in the future, which means it might do worse going forward. But so far, got to give them credit, it's held up okay, it just hasn't grown. The lower risk profile it goes for dampens the long-term upside potential. But in my opinion, the fact that it only sells options on up to 20% of the portfolio more than makes up for that. Other strategies like XYLD that sell call options on 100% of their portfolio have almost no chance to maintain a growing income stream over time. JEPI may or may not do that, but at least it does have a slim chance. If nothing else, it at least is not likely to produce a rapidly declining income stream like the weekly distribution ETFs from Roundhill. SPYI and GPIX don't have very long track records, and both have only existed in extreme bull markets, so past returns have limited value, but I'll show you anyway. SPYI launched at almost exactly the market bottom in 2022, yet its price is only up 5%, while SPY's is up 47%. GPIX has an even shorter track record, just about a year, but it's captured notably more of the S&P 500's upside than the other two. Even if you just compare them all over that same time period since GPIX's inception, that's still the case. Why is that? Well, JEPI invests in a lower volatility portfolio that doesn't have as much upside potential. SPYI writes calls that are 1 to 4% out of the money and on 75 to 90% of the portfolio. That's better than nothing, but it doesn't leave a ton of room for appreciation. An added wrinkle is that they can sometimes also buy a call option further out of the money to capture additional upside potential. But in my understanding, they don't plan to do that very often, so I'm not sure how much of a difference it'll make in the long run. GPIX writes calls at the money or close to it, so less upside potential just from that, but it only does that on 25 to 75% of the portfolio. Its max percentage is the same amount of SPYI's minimum percentage. GPIX also has the lowest expense ratio of the three, which all else equal should help its long-term returns. In the end, let's not overcomplicate things. With roughly the same underlying securities, both being based on the S&P 500, and SPYI trying to pay out a consistent 12ish%, while GPIX is only trying to pay out a consistent 8ish%, I think GPIX is likely to offer the most long-term upside potential and the best chance to create a sustainably growing income stream over time. To be clear, I think that all of these have a chance to do that, and none of them have a great chance to do it. But GPIX is the most likely, in my opinion. When it comes to downside protection, it's pretty obvious. There have been very few downturns of any kind to go off of since GPIX's inception, but let's compare them in the three biggest ones. From April 1st to April 19th, GPIX fell 4.9%, SPYI fell 4.5%, and JEPI only fell 3.2%. These are all with dividends reinvested, by the way. From July 16th to August 5th, GPIX fell 7%, SPYI fell 6.6%, and JEPI only fell 3.4%. From August 30th to September 6th, GPIX fell 3.8%, SPYI fell 3.5%, and JEPI only fell 1.5%. These aren't huge downturns, but there's a clear pattern. And of the three, JEPI is the only one focused on volatility. GPIX and SPYI are mainly focused on providing a steady level of income, and JEPI is mainly focused on creating a lower volatility, higher income version of the S&P 500. For that reason, JEPI is the clear winner in terms of downside protection. You may not care about that now since these other strategies have only existed in raging bull markets, but one day you probably will. That brings us to our final area of comparison, tax efficiency. This one has a clear winner too. Remember how I showed you earlier that JEPI showed a much higher SEC yield than the other two, and we'd come back to that later? Well, that time is now. Since JEPI does not write covered calls directly, they do it through equity-linked notes, all of the option income is taxed as ordinary income, meaning a higher rate than dividends or long-term capital gains for most people. Why would they do that? Probably because it allows them to show their option income in their SEC yield. So optically, it lets them show a higher SEC yield on their website, but it actually leads to lower after-tax returns for its shareholders. GPIX also does not really do anything to boost tax efficiency. They sell options on index-linked products like ETFs, which make their income taxable at the ordinary income rate if they're held for under 1 year, which, of course, all of them are. Of the three, SPYI is the only one truly managed for tax efficiency. They do this in three ways: buying individual stocks, selling calls on the S&P 500 index, and active tax management. Only a small portion of the income comes from dividends on the stocks, but for the most part, these are qualified dividends, which are taxed at a maximum rate of 20%, and only 15% for most people and 0 for some. I'm creating this video in 2024, and right now some politicians want to change that next year, but at least for now, that's the case. And of course, you can always go to the IRS website to find the current rates, even if you're watching this video 10 years from now. The second part is selling options against an index. Of these three ETFs, they're the only one that does that. It may seem like every covered call ETF would be doing that, but surprisingly, they're not. When you sell options against an index itself, like the S&P 500, instead of something that's simply linked to an index, like an ETF that tracks it, 60% of the option income is usually taxed at the lower long-term capital gains rate, and only 40% of the income is usually taxed at the higher short-term capital gains rate. If you're in a high tax bracket, that can be a big advantage over something like JEPI or SPYI, where its main sources of income are mostly or entirely taxed at the higher short-term capital gains rate. The third way they reduce taxes is through active tax management. Again, of these three ETFs, they're the only one that's doing this. The simplest way I can explain this is that there are often many things in a portfolio that are up or down at any given time, especially when you're investing in roughly 500 different stocks. SPYI's portfolio managers are able to harvest losses, which means marrying up something at a loss with something else at a gain that they're selling, which allows them to classify some of their income distributions as return of capital. When they do that, that portion of the income that you receive as return of capital is not taxable in that year. Don't get me wrong, you will have to pay taxes on all your gains eventually, but this process can allow long-term investors to defer some of the taxes until later and potentially pay the lower long-term capital gains rate tax on a higher percentage of their overall gains. As a reminder, gains on investments that are held for more than 1 year generally receive that lower long-term capital gains rate. So there you have it. Each ETF has its merits, and to me, there's no clear winner on everything. It's up to you what aspects are most important. In my opinion, none of these should be relied on solely for retirement income because, in the end, they're all covered call ETFs where you give up a lot of the upside of the underlying investments while keeping most of the downside. not a great deal, and not likely to create a sustainable growing income stream in the long run. But to each their own. This is not advice, just education. If you found this helpful, hit the like button, leave a comment with what you'd like us to cover next, and make sure to subscribe so you won't miss it. This video was a suggestion, by the way, from someone in our Discord, which you can join through the link in the description below. We'll look forward to seeing you in the next video.